All right.
Awesome.
Abe, you want to introduce yourself?
Sure. Hey, whoever's watching this, my name is Abe Chen. I'm currently in Manhattan in New York. And we're here to talk a little bit about real estate, the journey of investing, especially people younger on their 20s trying to get started and just getting the foundation, the basics, and getting the fear out of the way so you can actually do some deals and see the benefits of it.
Awesome. And do you want to give a little background? Like, how old are you? Where do you live right now? Where are you from? And how did you even get into investing in real estate?
Of course. Yeah, I'm currently 25 years old living in Manhattan, but I just recently moved here. Basically was born and raised in Minnesota. And then I moved to California, which is where I met Aushwin at an internship. We both went to Berkeley. And then I stayed in San Francisco for another 3 years before moving out here. My parents, my grandparents, everyone's in some form of medicine. So I never really had anyone to look up to for in terms of real estate or even in tech where I work. But I think there's a big gap in people who don't have that family experience and people who actually every one of these people should hear what we have to say and sort of get into it because it's a really good form of building wealth, building stability, and just sort of like learning about how finance works and how investment works. I think it's a great vehicle to learn from it. And you can see like how rocky the market's been in the past few months. Real estate tends to stay a lot more stable and it's more of a lagging indicator of some of the results of what happens in the markets. So yeah, happy to just share a little bit about all that. I actually got started myself like out of college, not with too much money, barely just like getting by every semester, and then got a job. So I'm just like maybe I should try to figure these things out. So then I joined Apple for my first full-time job, and I got connected to the investment club there. I attended one of the first meetings with the real estate investment club, which was really just like a group of 20 or 30 really old folks at Apple sitting around a table sharing their investment experience. Most people had one or two properties. The guy I was sitting next to, though, he went and his introduction was like, I just closed on a 400 unit building in Florida. And I thought, wow, that's pretty impressive. And then I said, I'm just here to learn. It's probably the youngest person in that room by a few years at least. But the lucky story of that is I ended up setting up a meeting with him to ask for a data question for one of my projects. And I was like, oh, hey, you're the guy that invests in real estate. And he was like, yeah. And then long story short is I never got my answer to the question about the data that I needed, but we did end up chatting about real estate. And I bugged him for probably the next 3 months until he decided he wanted to do a big deal in Kansas City. I got involved as a part of that syndication, which is more like a group funded real estate investment. And the rest is sort of history.
That's awesome. That's awesome. So just to recap, what did you study in college? You studied like computer science?
Computer science and economics.
Computer science and economics, graduated from UC Berkeley, joined Apple as a product manager. And then while there, you joined the real estate investing club at Apple. People way older than you. You're one of the youngest people in the room. You started learning. You asked the right questions, and eventually, one of the heavy hitters there, who was doing 100 unit deals, which is a lot. We can dig into that a little bit more. You eventually got him to allow you into a deal that he was syndicating.
Right,
Awesome,
exactly.
and that was your first deal.
That was my very first deal, my first exposure into real estate.
Okay, so there's a lot to dig into here because I think it's really important for anybody watching this, like any of our friends, anybody that we send this to, they're probably trying to get started with their first deal, right? Maybe their second, and maybe there's still some value there. So I think we should really double click on the first deal. First of all, let's take a step back. What the hell does syndication mean?
Let me just start by saying there's like multiple vehicles of real estate investment, some of which you probably heard of, some of which you might not have. So I'll just like outline the ones that are most commonly known. First is just like investing in single family real estate. This is like standalone units that house like it would sound like one single family. These are the homes that most of you probably live in America. There's multifamily, which a lot of people have been getting into more recently, which is exactly as that sounds as well. Apartment buildings, places where duplexes, triplexes, quads, places where more than just one family might reside. And then there's sort of commercial real estate, which is places where businesses are zoned to work. Think about the Starbucks next to you, the office building up on top of your like local, like down the street areas. And those are the types of investment properties. And then there's the different ways you can actually choose to invest in it. And so syndication is a private equity fund where you have general partners who manage the deal, source the deal, raise the equity, and then actually execute on the actual deal itself. and you have limited partners who, for a limited partner, the syndication is really just a passive investment. They put their money in, and then at the end of the year, they get a K1 form that outlines all their income and losses, and they just literally plug that into their tax forms and they're good to go. So essentially what a syndication is a good way to get exposure to real estate without actually having to manage as much, but definitely more than you would do on your own.
Got it. So the GP, aka the general partner, is the person or persons that are putting a deal together. They've probably found the property. They have probably some monetary interest as well, like investing in the property. But generally, they're trying to buy generally like a multifamily property or a very expensive property in some way. It could
Yep,
be a commercial property, and so they need to raise extra money for that down payment, right? And
exactly.
that's where limited partners come in. They're raising money from limited partners. So you
Exactly.
joined your first deal not as a GP but as an LP. Is that correct?
I joined my first deal as both a GP and an LP.
Okay, now
So,
we got to hear about this.
well,
So just to summarize, syndication is the word that's used when a GP goes out, a general partner goes out, and it's an investment vehicle where limited partners put money in. Which means
exactly.
as I'm a limited partner, all that means is like I'm just giving you my money. It's like very much like a passive investing, like as if I was buying a stock. I'm investing in your property that you are managing and you've put together, right?
Exactly. And you have partial ownership as a limited partner in that particular piece of property. And the GPs also have partial ownership of that property. They also have some management shares as well and generally have greater ownership. And we can talk a little bit about how the pricing structure works and how GPs get paid versus how LPs get their benefits. Definitely.
Awesome.
Yeah. So I guess just to outline a little bit more, as a part of a syndication, the benefits are scale, really. Like if you have the right deal and the right management team and you know what you're doing, a syndication is a way for you to really scale up, and your own capital is going to only take you so far. Also, being a syndication allows you to pull people in who traditionally won't have exposure to real estate, right? Today, we're seeing more companies pop up that allow for fractional ownership, REITs, fund rise, and whatnot. But really, back in the day, syndication is your best way to get exposure to real estate without being super involved in it. So how it works is there's a few numbers you should know as a limited partner. One is your preferred return. That is the promised but not guaranteed annual return on your money. So our deals, we always promise around 8% preferred returns, meaning that if you invested $100,000, you would get $8,000 a year in just pure cash flow. And two is the carry. So GPs are really rewarded on two main bases. One is just asset management, like 1 or 2% of the total assets under management to cover all the day-to-day operations at work. And then two is the upside. So when you sell, every GP, every syndication will have their own carry structure, but it's something like 20, 80, 20, where 80% of additional profits will go back to investors. And then if you make the 20% of that upside will then go to the GPs to reward the performance that they've done.
You buy a property that's worth $1 million. 4 years later, it's worth $2 million. So that extra $1 million, 80% of that appreciation is going to be doled out to the LPs, the limited partners
Exactly.
who just invested a check, based on the proportional ownership they have.
Exactly. And so the biggest differences between REITs and investing in real estate yourself is number one, the cash flow. When you invest in a syndication or when you buy a property, you get that month over month or year over year check to you. And then two are the tax advantages. So real estate will depreciate. So those are just sort of invisible paper losses, which in theory will wipe out the gains that you make on the property. So the difference between making $100,000 in a syndication and making $100,000 in a REIT really is that tax difference. How much you pay for, like, whether it's 20%, 30%, 40% on a REIT will likely be much lower if done right, if you're invested in a syndication or a piece of property yourself.
Okay, so the REIT in terms of benefits as an investor is just cash, like almost like a stock paying dividends. I'm going to get
Yep.
cash flow from that.
High dividend stock, pretty liquid, and different asset class to diversify yourself from the general equities market.
Okay, so that's a good comparison. It's basically like a high dividend stock when you're investing in a REIT. It's not that dissimilar from investing in like a stock, a common stock
Yeah,
of a company,
exactly.
because all you
Exactly.
know is like this is the company's fund, right?
Hmm.
I'm putting some money into it as if I'm buying their stock, and I'm going to get money doled out based on their performance. But the details on what deals they're doing in the individual deals doesn't matter. I just
Yeah.
get a lump sum share of their overall performance. Is that correct?
Exactly. Exactly. And so the biggest differences between REITs and investing in real estate yourself is number one, the cash flow. When you invest in a syndication or when you buy a property, you get that month over month or year over year check literally just delivered to you. And then two are the tax advantages. So real estate will depreciate. So those are just sort of invisible paper losses, which in theory will wipe out the gains that you make on the property. So the difference between making $100,000 in a syndication and making $100,000 in a REIT really is that tax difference. How much you pay for, like, whether it's 20%, 30%, 40% on a REIT will likely be much lower if done right, if you invested in a syndication or a piece of property yourself.
Okay, so the REIT in terms of benefits as an investor is just cash, like almost like a stock paying dividends. I'm going to get
Yep.
cash flow from that.
High dividend stock, pretty liquid, and different asset class to diversify yourself from the general equities market.
You're saying now the difference is you get that same kind of cash flow depending on the performance of the rental income of the property. You're going to have a share of the appreciation if that property
Yep.
appreciates when it's eventually sold. But you're saying that there's one other massive advantage to investing in a property directly through a syndication, through it as an LP, and that is
Correct.
tax benefits.
Tax benefits.
So I think we
Exactly.
should really start digging into that. What do you mean by tax benefits? In a property as an LP, how do I get any tax benefits from this?
Of course. Of course. So let's just talk about tax benefits in general. On a standard residential piece of real estate, there are laws in place that say that this property will depreciate at 1 over 27.5 of its value each year. So let's just do an example. If a building is worth $1 million, excluding that, we're going to exclude some of the details that talk about building value versus land value. But let's say the building value is worth $1 million. Then on paper, each year, you're taking a $36,363 loss. Regardless of whether you physically lost any money on this property, that's how much you get to write off against the income that that property is producing. So now let's say this property, $1 million property rented at, let's say, $5,000 a month, right? Then you're netting $60,000 a year in gross rents, right? But you subtract out the mortgage that you're paying on it, you subtract out any expenses, whether that's management expenses, that's property tax, interest payments, damages and repairs, that's probably going to get cut pretty aggressively. Let's say now you have $20,000 in net profit. Well, now your building actually depreciated $36,000 of it. So on paper, you've made no money this year, which
You
means you
actually
pay no
lost money, right?
tax. You actually lost money. And those losses carry
Quote
forward
unquote.
year over year, and you can continue to accrue those losses. So the key difference here is, as yes, you start to make income, you got to start to think about this whole piece as like a puzzle game. When you're an individual, you make money, the government taxes that money, and then you receive what's left over, and then you spend it. When you're a corporation, you make money, you spend money, and then what's left over, the government taxes you on it. So if you spend more than you make, whether that's spending it on a car or spending that on repairs or spending that on invisible losses, at the end of the day, if you have zero income, the government won't tax you on any of it. So that's a big difference between the way you can position yourself as an individual versus position yourself and your income as an entity to really save big on taxes.
That's awesome. That's a great example. So $1 million property, you said building depreciate every year. There's depreciation laws that say for any property, any residential property, buildings are getting depreciated
Yep.
at what one over what was it 27.5.
27.5, exactly. That assumes that in 27 and a half years, the full value of a home will need to be replaced, which obviously is not true,
So this
but it's
is
just
a
a
what you're
law.
kind of calling a invisible loss, right?
Exactly.
The laws say that that is the value that you are losing in your house, right?
Yep.
So what you're able to do is take the rent, whatever rental income you got from that property, then you have to subtract all the expenses that come with running a property, management, um, what's it called, property taxes,
Yep,
your mortgage payments, right?
exactly,
Then you're left with like a final, like this is the net operating income of my business, of my
exactly,
piece of real estate, and this is the depreciation that the laws say occurred on my property. Now you
yep,
can take that net operating income and subtract that depreciation from it, leaving
right,
you with zero or even negative, a quote unquote negative value that's coming out of that house. And
exactly.
because it's zero or negative, governments, you're not paying any taxes on that.
Yeah, I actually want to expand this example. I know we've been talking a lot about syndication, but I actually want to expand our point of conversation to all real estate, just so it's more relatable. Sometimes you might have a question like, how do I get involved in syndication? It's definitely hard to be a GP. It's definitely not easy to find opportunities in LP, but I want to
Mhm.
just emphasize that whether you're buying a home for yourself or whether you are, buying a commercial property or you're syndicating, these rules apply to everybody. And so the tax benefits across real estate are generalizable. So whatever we're saying here is really generalizable to how you want to invest yourself. And so that was like 101 of taxes. Then you can take that to different levels and we can get into that more if you want.
Okay, so I buy a property. Most people here are probably not going to be an LP. They may eventually, but for most people in America, statistically, the first
Yep.
property they buy is their own single family home that they then
Right.
live in, right? It's like buying a home is a huge thing. So all these rules apply to that, right? Now that's great. That means I don't pay taxes on a property if it's generating income in some way, right?
Right.
Is that still relevant? Are there any tax benefits if you own like a single family home and you're living in it? Like you're not really generating any kind of income if you're living in it, right? How do single family homes
Yeah.
work with tax advantages?
So depreciation doesn't really, now this is getting into murky territory because I've never bought a property to live in myself, but I think all of these will apply to investment properties. So in terms of actually writing it off when you're living it yourself, I think you lose a lot of those benefits, but you get some other tax benefits from being the primary homeowner that I can't speak as much to.
Got
So
it. So we'll
we're
focus
speaking
on
from a
mostly
lens
on
of investment.
investment
So
properties. Okay, got it. So now back to
correct.
investment properties. Everything you just described means that income on the property I'm not paying taxes on, which is great,
Right.
right? Um, Now, is there any way, I think that you might know of hopefully legal ways where you can reduce your tax liability as an individual making a W-2 income?
Yeah. So there's ways to do it. So the first is the very standard way. Let's take a step back and do some history, right? So there's two types of income and losses. There is active income and there is passive income, and same with losses, active losses and passive losses. So the state of your income or loss is dependent on the nature of your activity. So in the past, all real estate was considered passive, meaning that you could not mix your active W 2 wages with your passive losses on real estate. But then what the exception was made was, hey, look, if you're a real estate professional, which there is an actual definition for that, you have to spend a lot of hours a year and not be doing any other job basically, then these losses that you're making, these gains and losses that you're making in real estate should technically be counted as active since that is your primary form of employment and income. So then people started taking advantage of that. You can be certified as a real estate professional, and any investment property that you have, all the losses and gains on it will deduct off of your income. And so that's great, but that doesn't apply to anybody that is a W 2 worker, right? Because essentially, by law, there's no way you're working a 40-hour-a-week job and also maintaining that you're active in real estate
Okay.
professionally. So there's another way you can do it, which is not for folks like us, but if you're married, then you're considered one entity in a way. And if your spouse is a real estate professional and you share property, and let's say they're staying at home watching over the kids, then still all the income and all the losses on your collective properties will still count directly towards your income. And those losses can be used to wipe out your income. So this is a great way to do it if you're a dual income house or a dual household, really. One person can become that real estate professional and use that to give yourself a tax haven against your income.
Awesome. So before we wrap up, is there any other? So just to recap, you've covered, you know, the different types of investment properties. Whether you're buying a single family home and you're living in it, single family home and you're renting it out for rental income. You're participating as an LP in the purchase of. It could be a single family home, but more than likely is like a multi-family home where there's multiple units. Um, you could be a GP, a general partner, where
Yep,
you actually find the property, you get like some management interest, and you go out and raise money from other LPs. You can invest your money in a REIT for very, very passive income where you don't really care about all the deals. You just want real estate exposure,
exactly.
and it kind of acts like a high dividend stock. So those are all the different ways that you could get started with real estate. You've also explained what a syndication actually means. You've then got into like the tax benefits, the massive
Yep,
tax benefits, and kind of breaking down how that works, particularly on around depreciation of properties and how you can
right.
write that off against the income of the property. Is there anything else before we wrap up that you think the people in our network or anybody that was getting started in real estate should know?
I always like to start with some concrete steps that people can take since all of this feels a little unattainable when you hear about it. So first thing you can do is get educated. Asher and I are the only people putting out content on this. I highly recommend Bigger Pockets podcast, almost just jumping on Zillow and looking at prices of property, trying to do some calculations on how much you expect to rent it out. You can even go on Airbnb and see how much it's going for, or look at your local Street Easy, see how much similar properties are renting out for. Run the math on it. It's simple. It's just rent minus taxes minus mortgage interest is how much you're going to get, net some other expenses. And then the other thing I'll say is like, this is something that you just kind of have to do it to experience it. And to do to get started in real estate, there's two factors I think that are holding people back outside of knowledge, and that's the money. So the money, there's a few ways you can still get into real estate. One is how much of the property do you own? If you're an LP on a $10 million syndication, but you own a fraction of that, you can still be involved in a massive, massive property, right? The other part of that is how much of the down payment do you have? If you're buying all cash, sure, like a 20-year-old probably won't have $300,000 to put down on a home, but you can definitely do 25% in most cases. And if you are clever and work with your lender and your seller on it, you might be able to get anywhere from 10% down to 3% if you do an FHA loan, other types of like government backed loans. So reduce the amount of money you have in the property to get your foot in the door, lever up, which is another huge advantage for real estate. You're putting a fraction of the percentage down and accruing all the appreciation on the entire value of the property, and do that to get started. So those are ways you can really get started without having like 100, 200, $300,000 in the bank in cash.
Awesome. And if someone were to need, one singular resource to look at, is there any kind of is there any content creator or book that you would point them to?
Bigger Pockets, listen to what they have to say there, and then Google every term that you hear, and then talk to someone who's done a deal, run through maybe one of their models and figure out how it is that they think about it. This isn't rocket science. It's actually quite simple math. The only hard part is finding the deal, closing the deal, and operating it. You just got to get out there and look at deals, talk to real estate agents. I've probably talked to 30, 40, 50 real estate agents, a dozen different lenders, and they each are teachers in their own ways and they're open to sharing. And you get to learn a lot about like local deals, local economics, and real estate through all these folks that help you out.
The advice that I've heard several times from people who have done really well in real estate to get started on your first real estate investment property. I've heard that the best thing to do is to look for a duplex, triplex, or fourplex, somewhere between 2 to 4 units, as a multifamily property, and look into purchasing one of those. So you can actually go through the process of figuring out, okay, what are the projected rental incomes? Maybe you buy it in an area that you think is up and coming, that has a lot of opportunity, that maybe you can go see and manage yourself. Um, there's a lot of benefits to doing it like that way. Is that what you would recommend as well as a first time buyer of
Yeah,
real estate?
yeah, that's a phenomenal way to get started. I recommend that over single family to most people simply because if you're in a single family property and your tenants vacate, now you are 100% vacant. Versus if you have a duplex, you lose one, you're 50%, quad, 25%, 400 unit building. Well, you're probably not going to be sitting at zero very often. And if you are, that's a much bigger problem. So find that right balance between number of doors, number of beds, and the price to get yourself started in all this. And Austin touched a good point, like, how do you know where to buy real estate? That was a big question I had for the longest time. Honestly, there's a lot of ways you can index on it. Sometimes it's just knowing the local area super well, hearing about a place that's up and coming, but generally somewhere that's in a place of growing population, growing income, and relatively lower, reducing crime on a major line or near a metropolitan area is not a bad place to start. And you can find all that information on city data. If you just Google city data, it'll tell you trends for all these different statistics. And that's a good place to gut check yourself when you're looking at a new city to make sure it's not just you and your grandma that thinks it's a great place, but generally the trends also validate that as well.
Awesome. And in terms of actually finding the properties within those cities, so say I use city data to figure out this is a good city, schools are getting better, crime's going down, it seems like people are, a lot of activity, people are moving here. Um, property values are in the range that I could kind of afford. This is a good city for me to invest in. How do I actually go find the house to invest in?
Yeah, that's a great question. I think it starts with just looking at a bunch of properties for a long time. Literally, you have no obligation to purchase. So I would say just start making offers. Like you're not bound legally by making offers. And as you start to make those offers, you'll start to hear things, learn things. And the best way to start making offers and to find the property that's right for you is to talk to a local buyer agent who is really familiar with the area, can give you all the advice, all the insights, and shop around, talk to a few, see who works out with you well. Like I said, they're your best mentors. Their best interest is you closing the deal. And so real estate is a field where everybody's aligned between you, the buyer agent, the seller agent, the lender. They all want you to close on this deal, and to do so, they know that need to educate you. So whether that's me wanting to get into Atlanta as a market, I would first start by talking to a few Atlanta brokers, seeing what advice they have for me, and getting plugged into their deal flow. And they'll give you daily, weekly updates on what properties match your criteria. And then you just have to go and run the underwriting, look at the deal, and make some offers.
Okay, so that's your advice. Don't use like a Zillow or a Redfin or something to find properties. Actually go and contact the brokers who do this for a living, putting deals together, connecting buyers and sellers, right? The real estate agents. Find them in the local market. They're looking for clients like you. Tell them what you're looking for and get plugged into their email list. They'll start sending you actively, they'll start sending you deals that seem to fit your criteria. Like, I want a fourplex, I'm looking in the $1 million range. They're going to do that work for you. Hmm.
Yeah, don't get me wrong. Zillow is a really good place for top of funnel discovery. Like if you're trying to figure out which market you're even going to be in, jump on Zillow, filter by your criteria, take a look at those cities and see if it makes sense for you. But as you start to get closer and closer to executing on your first deal, my recommendation is unless you're a real estate agent yourself or you've done this so many times over, it pays dividends and it's educational to work with an agent. They'll take 3%, which is really standard. And you, on the other hand, get walked through this entire process. You can ask for an agent that's an investor. You can ask for an agent that works with investors. So they'll know exactly what you're looking for and be able to advise you on the right type of properties and the right type of deals.
Fantastic. The only missing link I see now is how do I find these agents? Like, say I think Nashville is a great place to invest in. I live in California. How do I
Yeah.
get an agent, get connected to it, the right agents there?
Whew, great question. I would say generally it's sometimes just the way you work. Like talk to an agent, make sure they have a lot of user experience. I like to work with agents are grown up in that area, so they know it deeply on a community level. I like to work with agents who work with investors, and I like to work with agents who like to teach. So those are the three main criteria. And then outside of that, you can buy a subscription to Market View Brokers, which is another tool which shows you different brokerages in a particular area. Zillow is actually a good place to find an agent. Redfin's a good place to find an agent, and referral, word of mouth, is also a lot of ways that agents get their business. You just have to look enough properties, look at enough areas, talk to enough agents, make enough offers, do enough deals, and one that will go through. That's when you start to learn. When you start getting your skin in the game.
Awesome. Well, thank you, Abe. Thanks for this breakdown. I think this is going to be super helpful.